Hello, I'm Kristen King, and welcome to Pros and Cons, the show where we take you through the risks and opportunities behind the trending ideas in the market. This week we're asking, is the recession over? That question came to the fore this week with the publication of the Bank of America's Fund Manager Survey. The monthly questionnaire canvasses the opinion of 220-plus fund managers who look after more than $630 billion worth of assets. These managers were asked whether or not they thought a recession was likely over the next 12 months, and 54% of them said no. That compares with a figure of just 28% back in September. So what have the fund managers seen to change their mind, and what does economic data tell us? The fund managers were also asked their thoughts on the shape of the economic recovery, and only 19% felt that a V-shaped turnaround was likely. A combined 59% expected either a bumpy W-shaped recovery or slower U-shaped bounce back. So the money managers are not expecting the next 12 months to be plain sailing. Yet 60% of them believe that the global economy is in an early cycle recovery phase rather than a recessionary one. That early cycle recovery figure has been rising steadily across the year, suggesting that institutional investors are becoming more bullish as 2020 wears on. Fund managers have been reducing the amount of cash they hold in their portfolios and putting that money to work, and that is also a positive sign. In fact, cash levels in their portfolios have fallen at the fastest rate since 2003 over the last 6 months. It appears that this money is going into stocks, with 27% of institutional investors saying they are overweight in equity markets in October. That's up from just 18% in September. Meanwhile, the number of managers who believe equities to be overvalued fell from 41% to 28% this month. On top of this, hedge funds have upped their exposure to stocks, with 42% of their net equity being allocated to the asset class. That represents a big jump from September's figure of just 30%. So, having established that the smart money is bullish about the economy and equities, what does economic data tell us is happening on the ground? This week saw the release of two key manufacturing data points, the Philly Fed and Empire State indices. The headline Philly Fed number smashed expectations, coming in at 32.3 compared to the previous reading of just 15 points and up from pandemic lows of negative 56.6. But not all the data in the Fed survey was as upbeat. The Empire State data showed a sharp fall in manufacturing output in New York, with the index falling by almost a third, from 17 to just 10.5, well below forecasts of 15. However, shipments and new orders data have picked up and continue to recover at a decent rate. The service sector is the bigger part of the economy, however, and the most recent PMI data from September showed a slowing rate of growth, with a reading of 54.6, down from the 17-month high posted in August of 55. Of course, unemployment data remains a concern. Weekly jobless claims jumped by 898,000 on Thursday, the highest number for almost 2 months. The fear is that the momentum in the economy, which emerged as we came out of lockdown, is now fading, alongside hopes of a second stimulus program this side of the election or even the new year. As a result, stock markets have been jittery. On balance, it's hard to be as optimistic as the money managers, and as such, for many traders, a defensive strategy is probably more likely than a bullish one over the next 2 to 3 weeks. Looking at Trackstar IQ, our proprietary search tracking tool, we can see Wall Street's focus remains centered on growth ETF funds like SPY and QQQ, which qualifies the Bank of America survey findings. However, interest in gold and silver-focused ETFs has risen, perhaps reflecting nervousness at the dislocation of data from sentiment. That's all we have time for this week. Safe trading.